What's good, YouTube? So welcome back to another one. Now, before I get cracking with this video, make sure you guys join us over at the Discord. Link is in the description below. I'm about to fire out our options watch list for next week in the markets, and we are big for the month of February and even bigger since we started off this year, right? So make sure you get in on the action. Link is in the description below. Now you see the video title on this one, and before I get going, what you guys need to understand is what we mean by bottom fishing. This is when you see a stock big off its highs, you believe it's at a deep discount, you believe it's undervalued, maybe there's some mispricing in the market, so that could be a lucrative opportunity to make a lot of money on the recovery of that stock. Now, yes, those investors that were bottom fishing out in 2008, financial crisis, out in 2018, taper tantrum, 2020 when the virus struck, made a lot of money in the markets by doing that. So it can be a very lucrative approach to the markets. And now, you know, these collection of tech stocks, think the Metas, the Netflix, the Rokus, the DraftKings, the PayPals, you guys know those names. The ones that are down heavy off their highs, 50%, 40%, whatever the case may be, have been hit like 25% in a single session. Those types of names are the collection of stocks that everybody wants to know about and everybody wants to be buying into right now. Now, I can understand the appeal to want to get into these types of names given they're down so far off their highs. And you've also got people who make the headlines, like a Cathie Woods, for example, coming out saying the stocks I'm investing into, they're going to be making pandemic highs, no problem. There's a massive misallocation out there in the market. People are investing too much into index funds. They should be investing into innovation. That's where I'm putting my money into. But listen up, if you like Cathie Woods, right, and you think she can do no wrong, what you want to do is just fast forward about 30 seconds, okay? Because you got to think about it like this. Imagine if she came out and said, guys, I think I made a massive mistake. I think my entries into stocks were trash, and I think I've been picking up the wrong things. And my ARK fund, we're gonna have a terrible year this year. Can you imagine what would happen? Imagine like the exodus out of her funds. Imagine her public image. So obviously she's got this image to keep. She has to show that confidence to the market, even if deep down she knows she's made some terrible decisions, all right? Some terrible investment decisions. She's got to put on that front. It's literally a must for her. She can't come out and say that things opposed to what she just said. She has to show that confidence to the marketplace. And there's tons of innovation within indexes. Like literally the QQQ, for example, it's run by like 6 different companies. The Apples, the Googles, there's tons of innovation behind those types of names. The Teslas as well, which is a name that she actually likes and invests into herself. And they haven't yet reached their peak, okay? So that there's all sorts of contradictions there, and that argument is just completely flawed. But anyway, these tech names, and literally, I get questions every single day. Is Facebook a buy right here? Should we be buying into Facebook? That's literally the #1 question I get right now. It seems to be there's a massive fascination with tech names, and particularly Facebook as well, picking up that name where it's at right now. And you know what? One of the most dangerous things you can do, and one of the things I hear all the time, is people saying, surely it can't drop any lower than that. Surely this stock has hit its low. Surely that's the bottom, okay? Because we're in an environment where retail investors, for some reason, the focus is always on that stock price, but what is often forgot is behind the stock price is an actual business, guys. There's a business behind the stock price, and that business is either doing well, performing well, it's moving sideways, or it's in decline. And that is where the focus should be. So even though these tech stocks are down massive, some of these are down 70, 80% literally from their highs, and I can understand the appeal and how attractive it could look, because it looks like if you get that bounce back, if you get that V-shaped recovery, you're gonna make tons of money, and that's the quickest route to being a millionaire. But this is the key. All these public companies, every 3 months, guys, they release their earnings. And those earnings are an insight into how they are performing, their financial health, and the direction in which they are going into. Now, tons of these tech stocks, guys, have come out, even though they're down big from their highs and it looks attractive. Tons of these tech stocks have come out with their earnings over the last couple of weeks, and now they're blemishes in their story for the short term. A lot of these names still have good long-term potential, but there are blemishes, clear blemishes in the short term. A lot of them have told you our growth is slowing down, our margins are weakening, and things are happening within the business, meaning we're not as strong as we once were. So that is the key. So that should be the focus, guys, rather than how much that stock price is down. Even though a stock price being down massive can look attractive, it can look like a lucrative opportunity. What about how the actual business is performing? And that is why I am not so keen to go ahead and buy into a Meta, for example, right here. Because imagine if you go ahead and buy into Meta, 3 months time, they've told you, yep, our growth is, the growth has slowed even more than what it had done. We're going to miss expectations again. The business isn't performing well. So naturally, the market reaction, if the market is moving correctly, should be to punish the stock again. So you could see stocks move down even lower. Really and truly, it should start from the earnings. It should start how the earnings are performing, and that should translate into good or bad stock price action. So in a couple of months' time, we're going to get another insight into how these businesses are performing. And if they're doing well, if they've improved, or if they're worsening. Now, if we look at 2022 is a tough year for business. You got to think high levels of inflation that affects margins of these companies. We know we're in an environment where interest rates are going to go up. And yes, that affects the tech companies more so than other stocks as well. And there's now a demand shift where you're seeing a lot of companies, naturally, the growth rates are slowing down versus the pandemic era, the 2020, 2021. These are things that aren't going away and should last a stretch of 2022. So it's a tough environment for business, and we shouldn't shy away from that. You got to accept that. So a lot of businesses are going through turbulent times. So the likelihood is when they start releasing their numbers, they're not just going to start coming out all guns blazing, firing on all cylinders in 3 months' time. The likelihood is they're still going to go through a very testing time, and that should be testing on their stock prices. And that's why a lot of these high growth tech stocks, there's no reason why we should see major bounce backs to the upside in the prices because of that, because of the environment that they are moving in. So that's the key, and that's why I'm not so keen to buy into a lot of these speculative, more high risk tech stock names which have blemishes in their stories. Now, there are other stocks out there in the market which don't have cracks in their short-term stories, like an Apple, like a Google. They are still performing exceptionally strong. They're still delivering to shareholders, still meeting expectations as it currently stands, even in a testing environment. But the majority of the tech stocks are not doing that. So the smart thing to do, even though these stocks look attractive right now, you could just be patient and wait for business updates when they release their earnings in a 2-3 months time, how they perform. Because if they decline and there's more weakness, and some of these names will decline in the next 3 months, the stock prices should logically show weakness. So the key thing is, and I'm not talking about a trading perspective, I don't care about that. Yes, if the whole market moves up and if Russia-Ukraine dies down, the whole market's going to move up. So those beaten down names, you will see a shift to the upside. But that's a trader perspective. Most of you guys are looking at these things from an investment perspective, holding on to them longer term. So if you do see a spike in the short term, it's irrelevant, okay? I had this one time, I actually gave you guys a heads up on this. I think it was Fuel Cell. Told you guys about Fuel Cell, told you guys about the financials. Look at the financials, they're not great. They're probably gonna trend down. I think literally the day after I did that video, the day after the stock price shot up, and everyone in the comment section was like, Sangi's wrong, the stock price is up. I knew it, he was wrong. But then look where the stock price is now compared to where it was when I did that video, and look at how their earnings, the evolution of their earnings have been. Okay, so it's not about short-term movements. We get spikes in the stock market, that is natural. But if you're looking at it from an investment perspective, those spikes will be wiped out very quickly, because what's going to happen is you're going to get profit taken and the stock price is going to move down. That could take weeks, that could take months. So it's about looking at it from an investment perspective. So it's the earnings that matter, and that should be the focus. And there's so much transparency out there in the market. So the smart thing to do, and that's not to say that it's the end of the world and that these tech stocks are now finished and they're going to go bust. No, the key is, the main key, the overriding thing I want to say to you guys is, you can afford to be patient in these markets, and patience will pay. Sometimes in the markets, the best move is to actually do nothing, and not many people actually come out and say that. If Cathie Woods did not buy into any of these stocks as they were sliding down, the performance of her fund would be much better. So sometimes the best move is to do nothing in the markets. Save the cash, hold it on the sidelines, and wait for some good opportunities. Just wait for better business performance, because when that better business performance comes through, okay, now you know the business is picking up steam, and now you can get in to that stock price at whatever level it is with confidence, knowing that the business is now on a roll and it's looking like they're gonna gain momentum moving forward. That is the intelligent thing to do. That's the forward thinking thing to do.